Bryce Doty, the yield on the 10-year Treasury bond is around 2%. It's lower than where it started the year. Most analysts thought it would be around 3% by now. What happened?
Well, I think everyone thought the Fed was going to do something, and they haven't. You saw unemployment come down. We're basically at full employment. You've seen inflation be low, but the Fed worries about employment cost index, and that's hovering right around their 2% target. So everyone thought, sure, the Fed's going to act, and rates will rise.
Well, you launched the Sit Rising Rate ETF back in February.
Right.
It seemed that you were pretty sure that rates were going to rise. They didn't. Your ETF is down around 5%, a little over 5% for the year. So what happened?
Well, we actually started 3 years ago with a rising rate strategy for our institutional bond clients. And we just recently did the ETF with the ticker RISE. And RISE is meant to be used in conjunction with an existing bond portfolio. So as your bond portfolio improves as rates come down, you'll have RISE. There'll be a bit of an offset. It's meant to just smooth out the ride. So with how volatile things have been, you know, people really are looking forward to having some sort of peace of mind.
And how does it work? Because it deals with futures contracts, right?
Right. So we're shorting futures contracts. Many institutional investors can do that directly, but what this does is it's just a turnkey solution for anyone to invest in. It focuses on the part of the curve that's going to move the most when the Fed does do something. So it has a lot of exposure to the 2- and 5-year part of the curve. So as the curve flattens, you're going to see a big pop in the performance there.
And what's your expectation for rates for next year? We're going to be hearing from the Fed fairly soon, but we're going to be watching them for the next few months, perhaps years. What's your expectation?
Well, while I don't think they'll do much, I think they'll leave rates unchanged. I think the markets will be anything but unchanged. It's going to be volatile. If they continue to focus on equity indices, if they continue to focus on the Chinese market and some of their policies, you're going to see people expect them to do something, late into next year. But if they pivot back, to what they have been focusing on, the domestic economy, there's odds that they could move rates in December. And that would be quite a shock. I think you could see yields spike tomorrow if that's the case. So that's the most important thing to look at, and how they describe or justify what they decide to do tomorrow.
All right, and then how does this fit into someone's overall portfolio? I understand that the institutional traders know how to use a product like RISE, but what about someone who's an individual investor just trying to figure it all out?
Well, using RISE or adding RISE to a bond portfolio reduces the interest rate risk of their bond portfolio, so they don't have as much downside if rates start to rise. And with just a 15 to 20% allocation, they can eliminate half the risk. And we think of it as collision insurance. You want to have it before the accident occurs, so before the Fed acts.
All right, well, thanks a lot, Bryce.
Thank you.
And thank you for watching The Street.